Hello everyone, this is Dr. Zhao at FTSU. In this video, I will show you very sharp futures contract trading strategy regarding your portfolio management. And the content of this section is not covered in the textbook, but I think it's a very useful content, and it's very easy to learn. Now, let's say after you graduate from MTSU, you got a job as a money manager, and you manage a very significant amount of assets. Let's say you have $1 billion assets under management, and in this portfolio you have 100 stocks. Right? And this year you did pretty well, and let's say you earned 10% return on your portfolio, and you are expecting a big bonus check for your Christmas from your boss. But your boss actually asked you to see him, and he found that the beta of your portfolio is too high, which is not consistent with your client's risk preferences. Although your returns is okay, you are making money for your clients. However, the practice in your portfolio is violation of IPS, investment policy statement, right? And in this case, you may forget about that big bonus check. Actually, your job, the security job, is on the line, and your boss asks you to fix the problem in 10 minutes. Otherwise, you may lose your job. Oh my goodness, your boss is a very mean person, right? And you know you have 100 stocks. It takes you a little time to figure out what is current beta, right? And in order to fix the problem, you need to lower the beta of your portfolio. How can you do this? You probably want to sell the stock with higher beta and purchase stock with a low beta, but it takes time, maybe a couple days. If you can do things quickly, very efficiently, I mean at least a couple hours, right? But your boss only give you 10 minutes. Looks like you definitely will lose your job, right? But don't panic. When you come across a situation like this, please call Dr. Zhao. Dr. Zhao have a very smart solution for you. How can we fix this problem? Well, let's take a look at one example, which will give you some idea on how you can fix the problem in 10 minutes. Here's a very simple example. Let's say the manager has $5 million equity portfolio, and he wants to increase beta from 0.8 to 1.1. And here we know that beta on the equity index futures contract is 1, and the price for equity futures contract is $250,000. So the key here is you don't have to trade stocks to change the beta of your portfolio. Right? You can add exposure of the futures contract combining with your current portfolio to change its risk-return trade-off. Right? You see, you have a long position stock portfolio, right? And this portfolio is subject to market risk, and beta is a measure of the market risk. And in order to adjust the beta or market risk level of your stock portfolio, the quickest way or the easiest way is to have the opposite position on the market index, and this can be achieved by taking a short position on stock index futures contract. Right? And here is a little calculation you needed to do in order to figure out how many positions that you needed to take to change the beta of your portfolio. Right? So here's the equation: number of contract, futures contract equals target beta minus current beta divided by index beta, then times the ratio of portfolio value and contract value. And the target beta here is 1.1, and current beta 0.8, divided by equity index futures contract beta, which is about equal to 1, and then you times this with the ratio of your portfolio, 5 million. Divided by $250,000 value of futures contract. That will give you an answer of 6. And this 6 means that you needed to take long position in 6 equity index futures contract in order to improve the beta of your portfolio from 0.8 to 1.1. 1. You don't need to trade any stocks. Right? Trading stocks means transaction costs. Right? Means time-consuming work, and actually you can achieve the same goal by taking a futures contract position, right? And actually you can accomplish this in less than 10 minutes. Right? You spend maybe 2-3 minutes to do a little calculation, then you call your broker, and in another 2 or 3 minutes your futures contract is in your portfolio and your problem is fixed. So you don't need 10 minutes, maybe 5 minutes to fix the problem. And in this case, what you need to do, you need to lower the beta. You need to lower the beta without trading stocks. So essentially, you need to take short position in stock index futures contract. And only thing that you need to do is, first of all, do a little calculation based on this equation. It will show you negative numbers, right? And second, call a broker to make that futures contract traded. And the futures contract can also be very useful in changing the risk-return trade-off, not only for stock portfolio, but for bond portfolio. And here's an example. Let's say you have a bond portfolio with a value of $5 million. And also we have some basic information about the bond futures contract. And the value for one contract is $100,000. Duration for the bond portfolio is 1.8, and your current duration for duration of your bond portfolio is 1.8, and the duration of bond futures contract is 1.6. And I mean, the riskiness of your bond portfolio can be measured by duration, and right now the riskiness is 1.6, which means for 1% change in interest rate, the value of your bond portfolio will change by about 1.6%. Right now, you want to increase duration from 1.8 to 5. Why would you do that? Well, if you forecast that the interest rate is going to decline, then you want to maximize again for your bond portfolio. One way to do this is to increase the duration, so you can increase the return for your bond portfolio if interest rate declines. And here you can follow the equation to calculate how many futures contracts you need to take to change the duration. Right? Target duration minus current duration divided by bond futures contract duration. Then you times the ratio of your bond portfolio value and bond future value. And here the answer is 100. 100 means this is a 100 futures contract, and this carries positive sign, which means this is a long position. So essentially, if you wanted to add risk exposure, you take long position. If you want to reduce the risk exposure, you take the short position. So through just the one trade, you can accomplish a lot of things. Suppose you are trading individual bonds in order to change the duration. Futures contract can also be useful for you to allocate assets between different asset classes or different sectors in your equity portfolio. And here's one example. Let's say you have 20 million mid-cap equity with a beta 1.5, and you wanted to move half of it into small cap equity with beta 1.4. Right? Small cap equity with beta 1.4. So here you want to increase the beta for that $10 million portfolio. And beta for mid and small cap equity futures contracts are 1.1 and 1.5, and the value for both contracts are $1/4 million. So here, without futures contract, what you need to do, of course, you need to sell mid cap equity first. Then you buy small cap equities. That's a lot of transactions that you need to go through. But here, to allocate assets between equity sectors, you only need to take 2 positions in the futures contract. Right? So the first thing is to replicate synthetic cash without selling equity. So here you simply want to reduce the beta of your 10 million mid-cap equity beta from 1.5 to 0. Right? So here 0 means beta equal to 0 means it's a synthetic cash. So your target beta 0 minus current beta 1.5 divided by the futures contract beta 1.1, the times the ratio of your portfolio value and the size of your futures contract to give you negative 38.2. That means you need to take short position in 38 mid cap active futures contract. Right? So combining your current portfolio and your short position in this mid cap active index market futures contract, you're replicating $10 million of cash. Right? And the second step is to increase your exposure of the risk from the cash part to small cap active position. So in this case, you want to improve the beta from 0 to 1.4 by using small cap active index futures contract, and the calculation will lead to 37.3, which means you need to take long position in 37 small cap active index futures contract. So here you don't need to sell $10 million worth of mid cap stocks and buy $10 million of small cap stocks. It's not necessary. You simply take two transactions: short position in mid cap active index futures contract and a long position in small cap active index futures contract. And this example shows you how a money manager can do pre-investment for their clients by using futures contracts. Let's say you're the money manager and you know that $5 million will be received in a month, right? And you actually introduce a new client to your company, and the contract has been signed, just that money is on its way. It takes 1 month for money to arrive your company's account. But you know that currently the market have great opportunity, and it's very likely that for the next month, bond market will both increase due to the lower interest rates, and you really wanted to capture this opportunity for your clients. But your clients' money is not there yet. How can you invest for your clients without having any money? Well, you can take a futures contract to do so-called pre-investment, right? And your goal is to replicate the structure of your current portfolio for your clients, so your clients can enjoy the positive return for the next month, even though the money is still on the way, right? So here's your portfolio. You have 70% in stocks with beta of 0.9, 30% in bond with 4.8 duration, right? And you have some basic information about the bond futures contract and the active futures contract, right? And here, to achieve this pre-investment goal for your clients, what you need to do is add risk exposure without spending any money. How? You take both. You take long position in both active futures contract and bond futures contract, so that the active market risk and bond market risk can be added into your portfolio for your clients. You don't like the risk, but the risk can bring you return. Right? So I will leave this to you as a practice to see the number of futures contracts that the manager needs to establish this pre-investment for her clients. All right, it's time for the homework. Let's take a look at some homework questions regarding futures markets and a portfolio management chapter. First one, today's futures market are dominated by trading in what contracts? What contracts? The answer is C, financial contracts. Financial contracts. Right? 100 years ago, it might be commodity futures contract, but right now it's financial futures contracts dominating the futures market, right? Especially the interest rate futures contract, stock index futures contract, and foreign currency futures contracts. Number two, synthetic stop position are commonly used by who? Because of what? Right? Synthetic stop position has great advantage, low transaction costs, and typically is commonly used by market timers, and the advantage is lower transaction costs. Number three, futures contracts have many advantages over forward contract, except what? Futures contract has no credit risk, but it's not tailor-made for forward contract clients. And the answer is B. For contracts that are tailored to specific needs of investment. This is a incorrect statement. It is forward contracts that are tailored to specific needs of the investor. Number 4, an investor who is hedging a corporate bond portfolio using T-bond futures contract is said to have what? And here, the hedge requires investor to take long and short positions simultaneously, right, in two different securities on the same underlying assets. But here, underlying assets are different. One is corporate bond, the other one is T-bond. Right, so underlying assets are different, but they are similar to each other regarding exposure of interest rate risk. So this is so-called cross hedge, right, with slight difference in the underlying asset to make this hedging strategy work. Number 5, in the futures market, the short positions loss is equal to long positions gain, because the futures market is a zero-sum game. Number 6, a wheat farmer should do what to reduce his exposure to risk associated with the fluctuation in wheat prices? So the principle here is, as a producer, always take short position in the futures contract to hedge against the commodity risk exposure. So the answer is sell wheat futures or take short position in wheat futures to hedge against wheat price risk. Number 7, interest rate futures contracts exist for all of the following except what? As those are underlying assets for interest rate futures contract, and D is not. Repurchase agreement, repo, is not an underlying assets for interest rate futures contract. Number 8, which one of the following exploits differences between actual futures price and their theoretically correct parity value? And index arbitrage, marking to market, reversing trade, settlement transaction. Of course, this is index arbitrage. And theoretical value can be derived from the future value of holding underlying asset of a stock portfolio, and the index futures contract will give you another price. If those two price different, then you can take the arbitrage. It's called index arbitrage. Number 9, the most actively traded interest rate futures contract is for, of course, treasury bonds. That's most popular underlying assets for interest rate futures contract. Number 10, an investor wanted to buy or sell what to explore an expected fall in interest rate. Fall in interest rate means rising bond price, right? And if you wanted to speculate, you wanted to take a long position in bond futures contract, right? So here you have two buy. One is buy treasury bond futures, the other one buy wheat futures. If you buy wheat futures, you're on the wrong side because underlying assets has nothing to do with the interest rate. So answer is C, treasury bond futures. Number 11, the S&P 500 index futures contract is overpriced relative to the spot S&P 500 index. You should do what? So here, buy low, sell high simultaneously. Where is low? Well, spot is low, whereas high, future is high. So you take short position or sell index futures, right? And buy the underlying assets in S&P 500. So the answer is C. Number 12, an investor would want to do what to hedge a long position in treasury bonds. And to hedge against a long position, you needed to take a short position, right? And you need to short futures contract that has bonds as underlying assets. And here, interest rate futures have treasury bonds as underlying assets. So answer is C for number 12. Number 13, violation of spot future parity relations resulting in what? Well, this violation is great because it offers you arbitrage opportunities. B for number 13. Number 14, In January the 1st, you sold 1 April S&P 500 index futures contract at a future price of 1300, and if future price is 1250 on February the 1st, your profit would be what if you close your position. You take short position, right? Betting on price will decline, and actually it did happen, right? How much? 50. Right? The difference is 50, and 50 times multiplier give you 12,500. Right? So D is best answer. Number 15, current level of S&P 500 1250, dividend yield 3%, risk-free rate 6%, and the future price quote for contract on S&P 500 due to expire 6 months from now should be equal to what? Okay, here you follow the future pricing equation. Current price 1250 times 1 plus interest rate minus convenience yield, which is equal to dividend yield 3%, and raise power of half because this futures contract will expire in 6 months, and that will give you 1268.61. Number 16. You believe that the spread between September T-bond contract and the June T-bond futures contract is too large and will soon correct. This market exhibits positive cost of carry for all contracts. To take advantage of this, you should do what? So the spread between two contracts, the same T-bond, but it's September contract versus June contract, and the difference going to shrink. Which one has higher value? Well, September T-bond will have higher value than June T-bond, right? And the difference too big, which means September T-bond is overvalued and the June T-bond is undervalued. So you buy low, sell high. Sell the overvalued, which is September contract, and buy the undervalued contract of the June. So the answer is B. Number 17, a 1-year gold futures contract selling for 1645. Gold price, spot price 15.92, and risk-free rate 3%. Arbitrage profit would be what? In this case, you look at theoretical future price by applying 3% at the interest cost, and that will give you $1639.76 of the future price for this gold. And the difference between the market price and your calculation is the arbitrage profit, $5.24. Number 18, a 1-year gold futures contract is selling for 1645 and a gold price 1592. Risk-free rate 3%. Which of the following set of transactions will generate positive riskless arbitrage profit? Right? So the first thing is to calculate the future price based on spot futures parity. Then you find the difference between current price and your calculation, and you buy low, sell high simultaneously. So A is the best answer. Number 19, a hypothetical futures contract on non-dividend paying stock with the current spot price $100 has a maturity of 1 year. TBL rate is 5%. What the futures price will be? This is very simple, right? 100 times 1 plus 5%, raised power 1, that give you 105. So answer is C for 19. Number 20, a 3 months forward on a stock with a current price of $30 and expected to pay dividend of $1 in 2 months. Risk-free rate 5%. What is the forward price of the stock? And based on equation, this forward price of stock equals stock price $30 minus the present value of $1, right? Of $1, and times 1 plus 5%. How many months? 3 months. That is 1/4. Right? How to calculate present value of $1? Well, this dividend will be paid in 2 months. So you discount this $1 by the same discount rate 5%, but the raise power of 1/6 because it will happen in 2 months or 1/6 of 1 year. Right, so they will give you answer of C. That concludes chapter 17.